Hello, I'm joined today by Justin King, the former chief executive of supermarket giant Sainsbury's. Now, he's now an advisor to Supermarket Income REIT. I'm also joined by Steve Windsor. He's a former finance and risk expert at Goldman Sachs and now an investment advisor to Supermarket Income REIT. Now, we find ourselves in a very unusual set of circumstances. The UK is currently in lockdown. People are confined to their homes. The only shops open are the food stores, and that's mainly the supermarkets. So that's put the likes of Sainsbury's, Tesco, Morrison's, and the other big food retailers firmly in the spotlight. Now, Justin, you spent many years in charge at Sainsbury's, and during a particularly successful period for the company, you're in a great position, hopefully, to give us some answers. The shelves are bare in many supermarkets. We've seen all the footage on the telly. It's essential items, they're not being restocked fast enough. Can the industry's supply chain cope?
Well, in a word, yes, the supply chain can cope. And actually, I think it's demonstrating live that it is. If you're watching this interview a few days after it's been recorded, I think you'll be going into supermarkets that are pretty fully stocked. I think you have to really understand the background context here. A typical supermarket will hold maybe 1 week's worth of stock. The supermarket chain itself, maybe another week within its warehouses. And over a fortnight or so, we've probably seen an extra week's worth of sales. And that's drained the pond to an extent. And of course, it's not even sales across all of the items stocked. It's very lumpy. And so pretty much as stock has been coming in, it's been going out. But I think in recent days, you can start to see the system playing catch up, because it can only really catch up once purchasing behavior returns to something approaching normal. And I think it is now. We saw a government minister say that people had overbought around £1 billion. I'm pretty sure that's a very significant underestimate. The grocery market, it does a bit depend on your definition, is about 150 billion a year, so 3 billion or so a week. I think it would be a reasonable assumption there's an extra week's worth of stock now in aggregate in people's homes. And with the sort of self-isolation challenge, actually, I think that's entirely logical and prudent on the behalf of consumers.
How do food retailers work with our suppliers in these circumstances? Now, surely farmers, bakers and others, they can only produce so much.
Well, I think the point is that we're not, as consumers, going to be eating any more, but a very significant change has taken place where we buy that food. And so the big challenge for the supermarkets really will be twofold. Firstly, within its existing supply base, how you increase capacity in the short term there. And in simple terms, it is about simplicity. You take a sandwich factory, for example, rather than making a couple of hundred SKUs every day, maybe cut back to 40 or 50, and immediately the factory productivity will increase 20 or 30%. And you can see that across the piece. Consumers are definitely going to have to get used to somewhat less choice within categories where choice has been a big part, like sandwiches. And of course, suppliers that traditionally have supplied the food service sector will largely not be supplying them now. And of course, that represents spare capacity that the supermarkets can pick up. And again, you can already see that resourcing taking place. So overall, the system can continue to provide food. And of course, there is a question about import and domestic production. It's not a terrible time of year, if one can say that about a pandemic, because we are coming into the UK season. And so UK producers would traditionally produce a larger amount of the food we consume over the next 6 months or so. But for now, at least, and this appears to be policy pretty widely across Europe and around the world, we are trying to keep our borders open for product. And so those flows are in large part continuing.
Might there come a point when stores do run out of supplies?
I don't believe so, no. I think there will be individual items, the much heralded toilet roll and hand sanitizer, where for a good while yet, it'll be what comes in goes straight out. But no, there's no real danger even of shortages. I've heard it referred to rationing taking place. Well, people probably need to pump World War II rations into a search engine just to understand really what rationing looks like. What we've seen, and clearly they've been hardened in recent days, is what I would call fair purchase policies, where retailers are trying to make sure that everybody gets a little rather than a few people get a lot. Those are pretty tried and tested policies for supermarkets. They've been using them for things like promotions for years. So, and on the whole, the vast majority of customers respect them. And so therefore, to the extent that there are still short-term disconnects, they're being managed by those fair purchase policies. But overall, no danger, no.
Supermarket share prices, they've risen sharply in recent days, and some grocers have reported a big jump in like-for-like sales. Now, this just looks like a one-off boost to profits. Is it, or is this something more sustainable?
Well, look, clearly there's a one-off boost to profits. Supermarkets are very geared to incremental sales. And of course, in recent weeks, it won't just have been the extra sales that they've taken. It will be over a largely fixed cost base. We do see now supermarkets announcing recruitment drives because they're struggling to cope with their existing workforce. So they're playing catch up on that. But I would expect we've seen much reduced promotional participation and, of course, at least for the last 2 or 3 weeks, much reduced waste. So not only has it been increased sales, but it's been at much better margins. So to that extent, it is a one-off boost. But as has become clear, our restaurant sector, our food service sector, is largely shut down now. And around 30% historically of calories would be consumed out of home. And in very large part, those have shifted into supermarket purchases. And so a main reason, I think, that we're seeing supermarkets recruit up is that they see good sales growth, reflecting that shift out of food service into the medium and longer term. Of course, it's, I think, a fool's errand to try and predict how long this pandemic is going to last. But I think it is entirely plausible that we will see a very long-term shift of some of the food service sector back into grocery retailers. In fact, at the moment, we're doing our shopping a bit like we did 20 years or so ago. We're going to shops much less frequently. We're tending to go to bigger shops, do a very big shop, and not top up as much for obvious reasons, because that's entirely consistent with the government's advice. So I do think there will be a long and lasting tail from this, but it's a bit early in truth to talk about that.
And lots of companies across many different sectors are cancelling or deferring dividends for understandable reasons. Are dividends in the supermarket sector sustainable?
In terms of many businesses, quite rightly, that are cancelling their dividends to preserve cash, clearly the one-off boost that the supermarkets are receiving, plus my expectation, and I think many others, that the supermarkets will be long-term beneficiaries of this change, means that there's no threat at all to dividends from a cash point of view. I think there is a secondary, if you like, political stroke societal perspective. I think it would be very difficult for any business to announce improved or enhanced dividends into the current environment, particularly when obviously not only are many, probably millions of people in truth unemployed or soon to be unemployed, many other people are having to batten down the hatches. A number of businesses that I'm working with or familiar with have already announced wage freezes. They've already announced wage cuts for senior executives, for example. So I think that the sort of political backdrop will mean that dividends at the current level, clearly cash sustainable, but I would not expect until well past the crisis that any cash flow boost could reflect itself in improved dividends.
If you look at the grocery sector at large, which we invest in the Supermarket Income REIT, but the grocers themselves, their balance sheets are becoming stronger in this period of turbulence rather than weaker, so separate and distinct to what's happening in vast swathes of commerce. So from their own perspective, it means their dividends are going to be more cash covered than they were previously. And then from our perspective at Supermarket Income REIT, as a landlord, Now, our dividend feels very robust because that rental income will continue to come in, and not only come in, will continue to increase with RPI, because we have contractual RPI uplifts on all of our rent, and we'll be able to pass that through to our investors in the REIT. So our dividend feels very stable for the long term, and by fortune, we find ourselves in the right sector for this particular crisis.
The supermarket stocks, they're typically defensive plays. That explains the recent jump in share prices. But of all the listed grocers, which is best, do you think, to thrive during this pandemic?
So each of the grocers are actually a little bit different. So if you look at Morrison's, for example, they own a good deal of their own supply chain, so well positioned in terms of controlling and enhancing that supply chain when needed in times like today. If you look at something like Sainsbury's, the angle they probably have is really the non-food and that whole combination with Argos. Because what a lot of the executives at the grocers have been doing is saying, well, what happened in other countries in terms of what happened when in the phases of this crisis? And whether you look at Italy or whether you look at China, certainly initially grocery food spend went up a lot. But then as the non-food retail space shut down, as we're now just experiencing in the UK, a lot of that non-food spend goes into grocery stores, which have a pretty reasonable range of non-food. Arguably, Sainsbury's has one of the best offerings because they actually have Argos in store. And if you read what's happening at the moment, Argos on the high street is shutting its shops, as the rest of the high street is, but Sainsbury's is maintaining Argos open in store. So we definitely think a second wave of this will be non-food sales going up materially in those supermarkets, and Sainsbury's definitely well positioned to benefit from that. And then if you look at Tesco's, well, they just benefit from size. I mean, given their size and their touch and their reach across the UK, most households live within a reasonable distance of Tesco's, and so usually they would also be larger edge of town stores, which is the stores that are benefiting the most, because people want to go and do a big shop, they're going to go to the bigger stores, and it's where Tesco's size and store network is really giving them a massive advantage. So all idiosyncratic, and we'll see benefits in different ways, but net, the rising tide here is lifting all grocery boats.
Now, Ocado shares have done best during the stock market rout. They proved very popular. Why is this? And is it justified, do you think? Should investors take Ocado seriously?
Well, I understand why Ocado, for many people, have been a standout stock, and you can see that in their performance. But I think that if you were to look at a lot of social media coverage, you'll see quite how much that business is struggling to cope with increased demand. Very long queues to get on their website, to place and or amend an order. And that really, I think, comes back to a simple truth, which is that online is around 7% of the market. And in the short term, even in extremis, I think it would struggle across all of the providers of online food to increase its capacity by, let's say, 50%. That only takes you into the low teens of the market. So online is not really going to be the main solution, if you like, to the challenges of today. In fact, if you think of that 30% or so of food switching back from food service, online's probably not even picking up its fair share of that, because it doesn't have, frankly, the capability so to do. But if you look at capacity increase, I would argue that it's the big grocers with in-store pick models, so Tesco, Sainsbury's and Asda, that are really best placed, because they can increase capacity in the short term more quickly, because in the end, it's about assets they already have, the stores, and your ability to shop those with your in-store shoppers. More in-store shoppers, and we are seeing recruitment drives for that very reason, and more vehicles, either the existing vehicles on the road for longer, used more productively, or new vehicles which are a relatively short order by comparison, say, to putting a new warehouse on the ground. So I think when you stand back and say, yep, online definitely is a winner in this environment, I think this really underpins something that the Supermarket REIT has long argued, which is it is those large supermarket stores that are truly multi-channel with in-store pick operations within them that are best poised for the longer term future. And that's being tested in extremis now. but it's clear that I think it underpins that core part of the investment thesis, why I've always been very supportive of it.
You're an advisor to the Supermarket Income REIT. Is this another way to play this defensive theme during this crisis?
Well, look, I think the REIT is a classic example of right place, right time. The assets that it owns are, I think, the best retail assets to own in this marketplace. I mean, I felt that, of course, before the pandemic too, but what we see is retail stores well positioned to take advantage of the opportunities of shifting volume out of food service back into grocery retail, the growth of online, because these are stores that do have online pick operations, and as we know, 80% or so of the food online market is actually picked in these well-located, well-sized edge and out of town stores. And of course, the occupants are having somewhat of a profit bounce. And so we're certainly not going to be seeing the supermarkets part of the narrative we're seeing more widely in retail of businesses looking for rent reductions and rent holidays to reflect their very distressed state. So from my point of view, this, albeit in extremis, really bears out the investment thesis for the REIT.
Well, if you look at the strategy of Supermarket Income REIT, and we've really focused on omni-channel stores. It's been a kind of core to our investment strategy to the get-go. What you're seeing happen now in real time is, the advantages of those multi-channel, omni-channel sites, which we invest in and own, are really the center of where all of this grocery spend is happening. Because they have people pushing trolleys and carrying baskets in the front, they have click and collect in the car park, and they have home delivery vans going out the back. They really are capturing all channels of this increased grocery spend. It's worth keeping in mind that actually online is a bit of a red herring. There's a lot of focus on online and lack of online delivery slots, but there isn't that much capacity in online grocery in the UK. It only represents about 7% of overall grocery spend in the UK. Even doubling that would be a huge logistical undertaking. So we think really they might get to 50% increase and maybe 10% market share. But really 85, 90% of all food being purchased in these current times in the last couple of weeks has been in store, which has been where our stores have seen most of their benefits. But it really is kind of a ratification of our investment thesis that these omni-channel stores are well positioned and key for the future model of grocery. It's just happening much quicker than even we expected.